and welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're in for a real treat with an exciting discussion ahead. It's our great privilege to be joined by Christopher Aaron, the founder of iGold Advisor. iGold Advisor is a sharp, independent research firm specializing in precious metals, commodities, and currency markets. Christopher brings a fascinating background to the table. He's a former CIA drone analyst who transformed into an anti-war activist, and now he shines as an expert technical analyst. Christopher, it's fantastic to have you back on Metals and Miners. Thank you so much for joining us today.
Gary, thank you so much for the kind introduction.
Yeah, no problem. All right, hey, let's go into a tour of the charts right away. I know as we were speaking before we hit record, there's some really exciting information that you want to share. So go ahead and jump in, take it away. And if I've got some questions, I will jump in and ask.
That's great. Thank you. So I just want to frame the backdrop here for the listeners, what we're talking about with the metals and the miners, the very companies that dig these metals out of the ground. So take a giant step back here, and for investors who maybe own a basket of these development stage and emerging mining companies, you will notice that we are living through this tale of two cities, where it is the best of times for the metals themselves. We have gold at an all-time high, never before seen in the history of humankind. We have silver at a 12-year high right now, but no one is paying attention to it that I can see. We've got copper near an all-time high. I mean, industrial metals, precious metals, the most important precious metal, all-time high. Yet if investors here own a basket of, let's say, development stage companies, as I do, as my clients do, they will notice that most of the companies digging these very metals out of the ground are currently valued at either multi-year or all-time lows. So, Gary, what the heck is going on? We have the metals at the all-time highs and the companies that dig these metals out of the ground at all-time lows. It's like, are we living in the twilight zone here, or what is happening? I've been discussing this with you. I've been discussing this with all of my colleagues across the board, and we're all trying to figure out, are we taking crazy pills, or what are we doing here? So what I want to do is explain to the listeners why this has happened, why we've seen this divergence between the metals themselves and the miners. And then I want to talk about what is coming, because literally in the last 2 weeks here, we are seeing signals that I couldn't possibly have fathomed that we would be seeing just a year or so ago. But we are seeing what I would call the most bullish signals that I could possibly ask for as far as what is coming over the next 3 to 10 years in that window.
And Christopher, it's important for those who are tuning in to understand you actually participated in the previous bull market between '08 and 2011. You're not just coming into this over the last few years, waiting for the next one. You actually participated, and you're applying your technical analysis with your experience to generate some of these charts that we're about to see and the intelligence that comes off of them.
Correct. And it just as a little bit of a backdrop, I was literally in the wars. I was in Afghanistan. I was in Iraq during the last cycle from 2008 to 2011. I was in the war as the crash of 2008 was happening. And by pure luck or providence, grace, let's say, from the higher power, I was given the opportunity to invest into the sector as everything was crashing in 2008. And so everything crashed, and this is where I really cut my teeth. All these miners crashed, gold fell, silver fell, the general stock market fell, the housing market fell, everything crashed in 2008. And as a 20-something-year-old at the time, I was investing into the sector. And then in the recovery from 2008 to 2011 is when I made my first small fortune, because a lot of these companies that had fallen by 90%, They rose 10 to 20x in the next 3 years, 10 to 20x. And so I know what a bull market in these miners looks like. And we have not been in a normal bull market here over the last 10 years. I want to explain why. I know what it's like when your portfolio starts to do things that your mind previously couldn't fathom. And it opens up possibilities in one's life to do what one wants to do, to live how one wants to live, to give, to play, to explore in all the different ways. And this is what my research shows is still ahead for this cycle. A lot of people have gotten super discouraged by this cycle. But if you're throwing in the towel right now, or if you've given up recently, I think you should consider coming back. And the data supports it.
Well, let's jump in. I'm excited.
All right, great. So let me share my screen here. Can you see the red backdrop?
I can, yeah.
Great. So we will start with this. This is why. This is why, if you've been participating in the precious metals cycle over the last 10 years, you've noticed that all these development stage companies have lagged so much. So here's the takeaway, and here's the evidence for it. The takeaway is that the market, the sum of human intelligence, has functionally treated both the Dow Jones Industrial Average, the top 30 industrial stocks in the United States, and gold, the 5,000-year store of wealth, functionally the same asset class for almost a decade. Don't believe me? Look at the two lines. Look at Dow in green and gold in gold. And look at how since the beginning of 2016, so now we're in 2025, almost 10 years, the Dow and gold have been moving more or less in lockstep. Yes, there's a couple brief windows here where one outpaces the other, but then the other one catches up, and look as a net sum. Both of these asset classes have been treated the same by the market. There's been this extremely tight correlation, and it's because of this. You have to think about the average investor. I mean, not the precious metals diehard, not the precious metals bull, but the average investor. We're talking about the average Western investor who's working a job, who has a family or kids or pets or hobbies, and they don't have time to focus on studying the markets day in and day out. These people have seen no need to own gold, even though the price of gold is up almost 160% in the last 10 years, because they have done just as well in their 401k funds or their superannuation funds in Australia. Every country has these. They've done just as well in their index funds as they would do in the price of gold. And so they have not seen the need to come into the precious metals sector. This is why there's been an absence of interest in the miners and in silver, even though gold itself has nearly tripled over the last 10 years. The average person has not seen the need to enter this sector. That's the first. That's the backdrop. That's the why. Now we are going to answer the question, well, has that ever happened before? Has there ever been a cycle where as gold rises, I just said gold has nearly tripled. Look at the current cycle here. We're talking about this green one on the bottom. So on the bottom,
can you open that up a little bit bigger?
Let's see if I can. I've got to show the title here at the top because this is important. So this is the biggest that it goes.
Okay.
Bottom part of the chart is the price of gold, 1970 through the present. Bottom is the price of gold. Top is the relationship between gold and the Dow Jones. So 1970 to present, Dow to gold on the top, 1970 to present, gold itself on the bottom. So remember, we just talked about, look at the red shading over here on the right. We just talked about how the gold and Dow have been functionally treated as the same by the market for the last 10 years, right?
Mm-hmm.
We just looked at that a moment ago.
Yes.
The way we can express that here is as a ratio. So all we're doing is looking at the last chart Dow and gold, but we're plotting it as a ratio. And so because this is red, because this is flat, the Dow to gold has been flat over the last 10 years, even as what? We said the price of gold itself is up nearly 180%. The Dow versus gold itself is flat. Notice that when we look at the previous cycles, whether we're talking about the 1970s here on the bottom where my mouse is, notice how as the price of gold rose by 2,400% in the 1970s, this Dow to gold ratio fell by 96%. In other words, the Dow lost 96% of its value as priced in gold in just 9 years. So gold itself was rising in the 1970s, and the Dow lost 96% of its value. Fast forward to the 2000 cycle here, year 2000 to 2011. Gold rises by 650%, and the Dow loses 85% of its value in 11 years. What's the difference? Which cycle does not match any of the previous cycles?
Right. It's the current one.
Exactly right. Exactly right. So I'm asking the question, it's sort of a rhetorical question because I've already answered it here, just to be explicitly clear. Has this ever happened before? In other words, the Dow versus gold moving in lockstep as the price of gold is rising? No, it's never happened before. Not once.
Okay.
So we are living through an anomaly. We have been living through an anomaly. And it is this anomaly that is the cause of why the mining companies are suffering so much. It's the lack of interest from the average investor around the world.
Can the anomaly continue indefinitely?
No. No correlation between any two asset classes will continue indefinitely. Let me bring that one up so we remember what we're talking about. This is the correlation, right? Mm-hmm. No correlation between seemingly diverse asset classes will last forever. It's the famous law, Stein's law. That which cannot continue forever
won't.
Exactly right.
Yeah.
And it sounds basic, but it tends to be in life that the most basic principles are the most powerful ones.
Mm-hmm.
This correlation has been going on for 10 years. We just looked at a moment ago that this is the only time that this has happened throughout history. These last 10 years are the only 10 years in history that the Dow and the gold have been treated as the same by the market on a functional basis, even though we know deep down gold is not the same as industrial stocks. But the market has had this view for the last 10 years.
Mm-hmm.
Okay, let's bring it now to the present. And this is why I'm so excited. And this is why I think if people have lost interest recently, they need to turn their frowns upside down. And they need to come on back. They need to come on back to this sector now. Here we are looking at the Dow to gold ratio. We were just looking at that on the top, except we're not looking 1970 through the present. We're looking 1900 through the present. So guys, take a step back here. If you need to pause the video, that's totally fine. If you need to literally take a step back from your computer, do that. But try to appreciate what we are looking at here. We are looking at, basically, just after the Industrial Revolution, inclusive of World War I, inclusive of World War II, inclusive of the United States abandoning the gold standard to back the dollar, all these major events, right? Dow versus gold. Which one is winning? The higher that this ratio goes toward the top, the better that the Dow is doing. The lower that this ratio goes, the better that gold is doing. We just talked about how we had been in an anomaly for the last 10 years. This little period, can you see right here, this little sort of rounded situation right in here from 2016 through the present, this sideways period. Aha, look what is happening. Look what is happening right now, Gary.
I see it.
We have a trend, this magenta, this sort of pink, this deep magenta color here. We have a rising trend in favor of the Dow that goes back to the year 1980. So this is a 45-year trend. You start in the year 1980, this major low when the Dow to gold ratio bottomed at 1. In other words, the Dow was worth 850 points. Gold was worth $850 back in the year 1980. This is what a peak looks like in the gold market. You come in best fit. Now, this is a principle of analysis. These trends don't always have to hit the exact lows of every single data point, but we do a best fit as they do in statistical analysis. We look at the sum of the data points. So the 2011 low right here, but then you notice the subsequent low here in 2012, matching very nicely with the low in the coronavirus panic, once per century panic type event in the markets. Notice that the Dow to gold ratio bottomed just a fraction away from this trend going back to 1980. And then we actually had another data point right in here just in October of last year. And so we have a very nice best fit 45-year rising trend in favor of the Dow. This trend since the year 1980 had been rising in favor of technology and in favor of industrial stocks, mainstream stocks, 401k funds, SPY funds, diamond funds, all the mainstream stock funds. Over just the last 2 weeks, we have begun to see this ratio break downward in favor of gold. Over just the last 2 weeks. Now, the ratio is currently at 14.5 to 1. In other words, it takes 14 and a half ounces of gold to buy one share in every company in the Dow right now. Look at the fact that over the last 125 years, this signal, this giant breakdown signal, has only happened 3 other times.
Today's video is sponsored by Monetary Metals. What if your gold could grow over time so that you're not just preserving, but growing your wealth in an asset that can't get inflated away by more money printing? Monetary Metals lets you do just that. You could earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even high as 19%, all in ounces of physical gold and silver. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver during the year. The question is this: why earn in dollars when you could earn in gold? Join thousands of investors earning interest in physical gold and silver every single month with Monetary Metals. So visit monetary-metals.com/Bohm to learn more. Yeah, now I will notice the first time it happened, obviously during the Great Depression, it just sliced through that rising trend line and it just plummeted. The next 2 times, though, it tried so hard to stay elevated, and it lasted a few years after it broke through that trend line. So, it came down and then it chopped around for a little while and then it finally gave up.
Excellent observation. Absolutely correct. Back here in the Great Depression, it sliced lower like a knife through hot butter. The reason for that is because gold was on a fixed dollar standard. Gold was worth $20 per ounce. And so the way that this ratio compressed, when stocks lost 83% of their value in 3 years, and by the way, we're talking about from the breakdown point of the trend, not from the absolute peak. If we measured from the absolute peak, it would be more like 95%. But from the breakdown level, the only thing that could happen is for stocks to lose 83% of their value, since gold was on a fixed standard. Mm-hmm. We fast forward to, for example, the 1960s cycle. This ratio broke in 1968. And so what happened was there was a bit of chop and grind. In other words, from 1968 to 1971. So this is an important principle for investors to understand when we look at the current cycle over here, we are witnessing the initial break of this 45-year trend right now. Back here in the 1960s, it was a 26-year rising trend, 1942 to 1968. And indeed, after the initial trend break, it can sometimes take a year or two for this ratio to begin strongly moving lower in favor of gold. In the case of the 1960s to 1970s, from the breakdown point right here, the red highlight, the Dow lost 96% of its value in 12 years.
That's just astounding.
I mean, it is. And these are, you can see the numbers right here. I'm not making these numbers up. You can calculate it for yourself. You take right here on the y-axis where this was, right around the 27 level, and you notice that by the year 1980, it compressed to 1. If you do 1 over 27, you're getting approximately a 96% decline. This is life-altering. This is life-altering analysis. These are life-altering moves that happen on these generational timescales.
And for some, it's life altering in a very positive way, and for some, it's life altering in a very negative way.
Which side do you want to be on?
Right.
The problem is that in mainstream financial analysis, if I can speak just between you and I for a moment, and the listeners, the mainstream financial analysts do not study multi-century cycles.
Mm-hmm.
They don't really go back. I mean, you think about the number of people who graduated from college or university, let's call it since the crash of 2008. We're already at 17 years. None of those people. So basically, I mean, if you graduate college at 22, anyone 40 years or younger right now has never witnessed a bear market in stocks. So think about all your mainstream financial advisors who just read their manuals, they read their textbooks, they get their Series 6, Series 7. They talk about investing in index funds, and they've been right for 17 years.
Mm-hmm.
They have no idea how these cycles can change when every couple decades, they just happen to be on one cycle. They have no idea how these cycles can change in the opposite direction for a completely different asset class, such as gold and precious metals.
It's amazing. So one other thing here. So in 1980, we almost kissed the 1-to-1 ratio. I've heard some folks saying that they believe we're going to get back to a 1-to-1. Where do you believe we'll end up? Will it be 1-to-1, 2-to-1, 5-to-1, 20-to-1?
If we take the average of the only 3 historical cycles that we have, the average calls for an 86% decline from this point, from where we are right now, in 8 more years. That would be the average. If it's going to be the average, then the Dow to gold ratio would bottom at about 2-to-1. However, just taking a simple average is not enough. There are a lot of other technical levels that I'm going to be looking for. There are going to be Fibonacci retracement levels to monitor the entire time. There are going to be some other support levels back in here around the 2011 low that I'm going to be watching. We'll be watching the 1933 low. We'll be watching the 1980 low. My best estimate at this point in time is anywhere between 2 and 1-to-1 is where this ratio is going to bottom, plus or minus 5 to 10 years from now. So just to put that into number terms, I mean, the Dow is currently trading at 43,000, and gold is at 3,000 per ounce. If it were to bottom at, let's say, 2-to-1, we might be talking about. I mean, there are various ways that the ratio can compress, but if it was to bottom at 2-to-1, let's say my more reasonable level, we would be talking about the Dow coming down roughly to 20,000 and gold being worth 10,000 per ounce.
Or it could just stagnate, stay at around 40 grand, and gold just, continue to march higher to 20 grand.
Exactly right. Exactly right. And people right now will talk about those numbers, and they will look at me like I'm some sort of creature from outer space with three heads, and they'll say, are you out of your mind? Like the Dow losing half of its value and gold rising from 3,000 to 10,000 or 20,000? They'll say you've got to be crazy. You've got to be insane. And I'm saying look at the data. Look at how in all of the previous cycles, when this ratio breaks these multi-decade rising trends in favor of the Dow, this thing doesn't just, it doesn't just move lower by 1 or 2 points. This thing loses on average 86%. You calculate that out to where we are today. You think about fundamentally, I mean, I don't like to spend too much of my time talking about the fundamentals because I think it's more clear to look at the what. This is the what rather than the why. But for a moment, if we talk about the why, I mean, the levels of debt around the world, the fact that debt to GDP in the United States is more analogous to where it was after World War II presently, yet we haven't just fought a world war for the last 8 years. Where has all this debt come from? You look at the fact that you've got this war raging in Europe. The United States has just pulled out. I mean, the greatest contributor of the campaign against Russia, Trump has just said that's it. There was this meeting just a week ago, Gary, and it blew up in Zelensky's face, and Trump says that's it. We're not helping you anymore. And now the rest of Europe is stepping up and saying, hey, so we're going to help. Look at what's happening to the bond market in Europe. I mean, 10-year yields are skyrocketing across the European continent. Gold we haven't touched on this, but gold in foreign currencies is at all-time highs in every European country.
Everywhere.
Euros, Swiss francs, British pounds, Norwegian kroners, Swedish kroners, everything. So the gold market is saying it's either the debt levels or it's the war or it's everything combined, but that something is seriously shifting. The important point to note about this chart here is that, as you talked about a few moments ago, as we saw in the previous cycle or the 1960s cycle, this shift from industrial to safety is a process. It can be a process. You're talking about tens of trillions of dollars around the world that are slowly and surely, you think about each of the central banks acting, each of the sovereign wealth funds acting. We know it's not mainstream investors. We talked about that. The mainstream Western investor is nowhere near this market. It's the high-powered money that is slowly but surely. You have fund managers, you have central bankers that are saying, hey, okay, today it's first quarter of 2025. Let's move 1% of our assets from bonds into precious metals. You multiply that out by 25 central banks around the world, each acting on their own timescale, sovereign wealth funds, some large institutions, hedge funds. This is a process. We're seeing the beginning of the process. What this chart is showing us is that the process is beginning to accelerate.
It's like the green light has gone, the starting gun has gone off, and the race has begun now.
Exactly right.
Yeah,
exactly.
It's really interesting. So, okay, I know you have one more chart, but before we go to that chart, let's just briefly, quickly touch on how the miners benefit when you see this and this isn't the right analogy, but this fourth turning in a way that's about to take place. And I don't mean it the fourth turning in the sense of the Neil Howe fourth turning. I mean on your chart. We're looking at a fourth turning on this chart. How does this benefit the miners?
This is the signal that we've needed to see to show us that the speculative bid, I'm going to call it the speculative anti-fiat bid, anti-mainstream bid. And by that, I mean the average investor, the average Western investor, who we talked about is not in this market presently. I'm already seeing it in my business, working with individuals via consultations and in more of an advisory role. I'm seeing it where I have some individuals saying, price of gold is $3,000 per ounce. Like, think about the average person who has bills and expenses and all these things going on. The average person doesn't have 3,000 extra dollars at the end of the month, especially not to buy one little ounce of gold. I mean, it seems like they're not getting enough for their money at $3,000 for an ounce. So I'm seeing this for the very first time. What I'm talking about is the average Western investor having that thought. Imagine gold goes higher. Imagine it's 4,000, a year or two from now. And they say, I don't want to part with 4,000 of my dollars for one measly coin. Instead, I'd like to buy, wait a minute, I can buy 50 or 100 ounces of silver for.
Yeah, that very psychological mindset you're describing makes me think that this gold bull run will have fewer participants, but the silver bull run will have more, and it'll go higher and further.
It will. And let's add the last category to that. It's the mining companies for both gold and silver. And the reason for that is because for the average investor, let's say doesn't have $3,000 at the end of the month, but maybe has $1,000 or $500, it's much easier for them to log into their brokerage accounts and type in the word gold or silver and say, oh, here's a list of 20 different gold and silver companies that just showed up. I'm going to put $100 into a basket of 10 or 20 of them, and I'll just do that at the end of every month. You multiply that out by several 100 million people around the world that go back to the Dow to gold chart. If you doubt me that this will happen in this kind of way, it's only because you're thinking about the last 10 years when the Dow has done just as well as gold. And so that average person has been looking at their retirement accounts saying, why would I think about this shiny rock, right? They are not going to be thinking that when they start to see negative returns on their 401k funds, on their retirement accounts, and they start to see little hints, little percolations in the mainstream press. Hey, gold is up another $100 this week. Wow, gold just crossed 3,300. Gold is now at 3,500, but I just lost 10% in my retirement account over the course of the last quarter. Wait a minute, maybe I should. And then you connect the dots, and then, but goodness, it's 3,500 for an ounce of gold. This is why eventually, and it's not going to happen in a straight line, and it's not going to happen today and tomorrow, but eventually silver and the gold and silver mining companies are going to move in a parabolic fashion in percentage terms, much greater than the move that will be significant in physical gold in and of itself.
That's amazing.
Eventually.
All right, well, so let's see that last chart that you have for us.
Yep. So we want to talk about you want to talk about where the average person is right now in this sector. We just talked about how the average person is probably not going to be parting with too many $3,000 increments for physical gold.
Right.
But what are they going to be doing? It's looking at silver and the mining companies. So let's take the next logical step, physical gold to physical silver. Here's the price of silver on the top, 2020 through the present. Price of silver is now 7% above its 2020 peak. Look at where interest in that very silver price is. This is analysis from Google Trends. What are Western investors in the United States? And of course, this is going to apply to most Western democracies around the world. The interest in this very thing that is higher, the thing is higher by 7%, but the interest in the average person is down by 75% from where it was just 5 years ago. And that corresponds to the previous peaks here in silver from 2020 and early 21.
Yeah, it's astounding. But I'll tell you, it looks like in the last maybe 12 months or so, there's a slight elevation to the interest. So it looks like maybe we're at the beginning stages of, a move higher in interest.
Yes, just the very beginning here for this cycle. And these cycles are going to play out in waves. We're going to see waves coming. We're going to see temporary peaks in the interest. That'll coincide with a temporary peak in the price of silver. Silver will either consolidate or retrace. We'll see the interest from mainstream investors come back down. But it's very important to follow this sort of relationship over short run and also longer cycles.
That makes sense. Yeah, so I appreciate your walk through the charts with us, and you can return us back for the
Yep.
next part of our discussion here. So I want to first say, hey everyone, welcome to the fantastic interview that we're having with Christopher Aaron, founder of iGold Advisor. This has been an amazing discussion so far. We really appreciate the intel that Chris is giving us, Christopher. And before we wrap up with our final set of questions, I want to direct everyone interested in this sector and investments to dive into our Substack at metalsandminers.substack.com. Join the community, receive a free report titled If You Don't Own Gold, You Know Neither History Nor Economics. That's a famous quote by investing legend Ray Dalio. Consider upgrading for access to premium content. All premium content provides a comprehensive analysis of global trends, asset sentiment, and deep dives into individual miners for more informed decision making. But even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thanks again for watching this interview. Now, I'm positive that you've enjoyed this conversation with Christopher as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, so Christopher, before we finish out here, I want to go to what I call our lightning round. And at the end, we'll reserve that spot for a question about a couple of specific miners that you like right now. So I'm going to ask you to rank a few assets as a buy or a sell. Give it a score of 1 to 100. 100 is an extreme buy, a 1 is an extreme sell. Okay, then just give one or two sentences as to why you take that position. And if it's an asset that you're not following, that's okay. All right, you ready?
Yes.
All right, on a scale of 1 to 100, is gold a buy or a sell, and why?
Let's put physical gold at a 70. So it is a buy. However, it is no longer a bargain. It is no longer at a major bottom. It appears that it's had a significant move. It appears that it will have a more significant move over the next several years. However, it is not the bargain presently that some other of the aspects of the sector are in.
Okay. Gold miners, 1 to 100.
90.
And why is that?
90 as a buy. Uh, because we are seeing the macro signal already in gold. I said gold is at a 70. The miners are even stronger buy than gold because their valuations, as we talked about, the valuations of the miners, even though gold is at an all-time high, the valuations of many of these development stage gold miners are at multi-year or even all-time lows concurrently. And you don't get this kind of divergence very often in one's career. I'm looking at this as being basically a rubber band effect. You have the physical gold stretched with the gold miners, and I'm looking at when this thing releases the gold miners to snap back up. The only reason that I don't have that listed as a 100 is because the sector is extremely volatile, and it's possible that over the short run, I mean, these miners are so volatile, they can move higher 10 or 20% in any day, any week. So the only reason I don't give it a 100, but I give it a 90 as a buy is because of that extreme volatility.
All right, let's move to silver, 1 to 100. Buy or sell, and why?
I'm going to give it a 90 again. There's a very similar correlation between silver and the mining sector. The gold to silver ratio is extremely stretched in favor of gold. I do believe that silver has tremendously higher upside than physical gold over the course of the next 10 years. However, silver also suffers from that volatility sort of situation similar to the mining equities.
All right. Silver miners.
Uh, I would give the silver miners, let's call it an 85. An 85. The upside in the silver miners are even greater than the upside in either physical silver or the gold miners. So you have the greatest amount of upside in the precious metals sector in the silver miners. However, the volatility in the silver miners is the most extreme in the entire sector.
Copper, 1 to 100.
I'd have to give copper a 65. I think copper is a buy here. I think all real assets are going to come into favor over the course of this cycle. However, there could be periods in the extreme downturn in the Dow to gold ratio. We have to remember the Dow, the full name for the Dow is the Dow Jones Industrial Average. Copper is an industrial metal. At certain points in this cycle, if we're in an extreme fear reaction, copper would be expected to suffer more than gold in that period.
Uranium, 1 to 100.
50. You have the real asset side of things. I think there's going to be a rotation from stocks and mainstream equities into harder assets in general, real assets, resource markets. However, I do anticipate that the energy sector will be the worst performing of the commodity space in the compression in the Dow to gold ratio. And that's because, as we saw during the coronavirus, oil and the energy space tends to be very sensitive to compression in demand due to fall in industry.
Okay, I am going to ask you about oil, but let's stay with uranium and stay on the uranium miners first.
I'd put the uranium miners at about a 40, less than the physical mineral itself. Those miners are going to be extremely volatile, and if the energy sector compresses, investors are going to want to wait until the end of the worst part of the sell-off in the Dow to be more aggressive on energy miners.
Okay, oil.
30. It's more of a sell. There is a big bearish pattern setting up in the West Texas crude market itself. There is extremely important support going back for the last 3 years at $62 per barrel. If 62 breaks on weekly closes, it has not yet. I always take the market in chunks. I give my best analysis at the present moment in time, and I fully admit when I do not have a crystal ball, which I do not right now. But that said, if that 62 level breaks, I have a significantly lower target for oil over the next several years, up to and including a situation like we saw in the coronavirus where oil actually went to zero and it actually went negative briefly. So in sum, I am quite cautious on the energy space here, especially in the worst of the compression in the Dow to gold ratio.
And that could be very problematic for the producers of shale, who I think need somewhere in the $50 to $60 range to survive. So
yeah,
so that could
exactly
be
right.
Yeah, that could be a major problem. All right, the Nasdaq 1 to 100.
We've got to put the Nasdaq at about a 35. I have two opinions on technology in the world. I'm not bearish on the state of the world and the state of let's say the capacity of humankind. I'm an optimist. I think over the course of the next generation. We're going to get extremely efficient at producing energy. We are going to get extremely efficient at bringing together the sum of the world's knowledge through artificial intelligence and other means in ways that can increase human lifespan, increase health, allow us to access parts of our capabilities that we have not had the ability to access as human beings. I think we're going to be exploring asteroids, exploring Mars, exploring underneath the sea. Who knows what we will find there? I think this is analogous to sort of before the Mayflower ship sailed from England to what is now the United States. So big picture,
but getting there is going to be volatile and tough.
Exactly right. And those big picture themes, so we were talking about technology stocks. I think certain specific technology stocks can do very well over the course of the next 10 years. I think, though, the entire sector is overvalued presently. So it's really going to be a picking and choosing kind of market. But I just wanted to be clear.
Yeah.
I'm an optimist on human beings. I'm bullish on human beings. It's just that we have way too much debt, and there's way too much potential for more debt due to the wars and the inflation around the world. And it appears to me that needs to be resolved first before we take these major new leaps.
Okay, I appreciate that, and I hear your heart coming through there. All right, S&P 500.
20. It's a fairly strong sell. Fairly strong sell. Again, there are going to be a few specific technology companies in that S&P 500 index that perform well, but the overall index itself is a sell.
Okay, short-term treasuries. We'll say like a year and less.
I'm okay with short-term treasuries. I'd put them at a 50. I have some cash parked in short-term treasuries as well. I actually think that the Federal Reserve is going to be forced to hike interest rates over the course of the next several meetings, in contrast to what the market has been anticipating. So I think you could see rates on the short end moving higher. It's okay to park some cash there for the short run.
Okay, and long-term treasuries. We'll say 10, 20, 30.
0. It's the strongest sell. It's an even stronger sell than, let's say, the S&P 500 or the NASDAQ indices.
I hate to say this, but it's the kid that you don't want to pick for your dodgeball team.
Yes, and it's probably going to be the only 0 that I give. The only thing worse than holding too many dollars right now. Again, it's okay to hold some dollars right now because we need to pay the bills, and there are going to be mini cycles where some things crash in value. Maybe real estate comes down, maybe certain technology stocks come down that you want to scoop up in the future. So it's okay to have some cash short term, but there's nothing I would move away from stronger than locking in a low interest rate for 20 or 30 years.
Yeah. Yeah. Very well said. And lastly, in this section here, on a scale of 1 to 10, with each representing a percentage, 1%, 2%, 2.5%, 3%, whatever, where do you see inflation ending the year? And it could be a range.
I think we will be ticking back up toward 4% by the end of this year.
Okay. All right. Now let's turn our attention to a couple of names that you like. You don't have to go into whatever detail you feel like. We'll just keep it to, a minute or two. A few equities on the mining side.
Yeah, I appreciate that, Gary. Because we are talking about the miners here, and so I just want to remind investors that big picture backdrop. We have this unique rubber band situation right now where the price of gold is bumping up against $3,000, but you have the entirety of the development stage companies that are trading as if gold was like 1,500, because we've yet to see that mainstream Western investor start to move back into the sector. But we already see the beginning of the signal on that Dow to gold ratio. It's rounding over right now. So for investors who understand this, you've got gold at an all-time high, you got silver at a 12-year high, but you have most of the gold and silver miners trading at multi-year lows. If you have the volatility tolerance for it, remember, that's why I didn't rate these as 100, but I gave them a 90. If you have the volatility tolerance for it, just want to mention two names that all I'm doing is mentioning names that I have money in myself, that my clients have money in. So I'm basically giving away these picks for free. I don't take any fees from these companies. It's not my business model. Provenance Gold. Ticker is PAU in Canada and PVGDF in the United States. Not Providence, Provenance. Providence Gold has made a new discovery in Nevada just 3 months ago. It's a historic resource, not 43-101 compliant, but back from the 80s and 90s, the estimate was 2 million ounces of gold in the ground. It's in Nevada. It's near the surface. The first drill hole of last year, they found visible gold 3 times below the historical resource model. So if this thing is 3 times bigger than they previously thought, you've got a monster on the hands in Providence. Very volatile, but I think this could be one of the big names of 2025. And then on the silver space, I really like the development stage companies that already have these nice silver resources in the ground that are just being valued at pennies on the dollar because you haven't seen that interest in silver like we've talked about. So Southern Silver Exploration is a company that I really like. I own. My investors own this company as well. It's nowhere near its recent peaks from the last few years. You still have a lot of upside with that. Southern Silver is SSV on the Canadian and SSVFF in the United States. Southern Silver, the reason I like it, they got 300 million ounces of silver equivalent in the Cerro Las Menitas project in Durango, Mexico. And it's it's an underground high grade mine. It's the average grade you're getting into 400 to 500 grams per ton, and it's below ground. So there's no fear about maybe any of the open pit banning that they might do potentially in Mexico. So Provenance and Southern Silver are two names that we are invested in here. Might want to check them out.
Okay, appreciate you sharing those. I'll put the tickers up in the part of the video that you just mentioned, each one, so that everybody could go check them out. And I'll try to put them also in the description area with a link so they can go pull it up through Google or something. Christopher, thank you for coming back on to Metals and Miners, for being so generous with your time, analysis, and ideas. Would you let everyone know how they can connect with you and learn more about your work?
I appreciate that, Gary. Yeah, the website is the letter I and then goldadvisor.com. And they can also find me on X or Twitter. The handle is @iGlobalGold. And I post quite a bit on there these days. So there's a lot of free charts, free analysis that goes out there. I post some of the articles that I publish on Gold Eagle. A lot of good stuff to check out.
All right. Awesome. I've been following you for a while, so I really appreciate all your work and all that you share. And everybody else, you need to go check them out. I look forward to having you back on, Christopher, sometime soon. Thanks for being here with us. And everybody else, thanks for watching.
Thank you very much, Gary.
Hey everyone, welcome to the fantastic interview that we're having with Christopher Aaron, founder of iGold Advisor. This has been an amazing discussion so far. We really appreciate the intel that Chris is giving us, Christopher. And before we wrap up with our final set of questions, I want to direct everyone interested in this sector and investments to dive into our Substack at metalsandminers.substack.com. Join the community, receive a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio.